Everybody hear me? Good. Very good. Well, good morning, everyone.
Good morning.
It's nice to see a great full room here. There's still a couple of chairs in the front if someone wants to come all the way to the front instead of standing at the back. So my name is Andris Berzins. A little bit higher on the mic. Thank you. A little bit loud? Good. Okay. You hear me? Hear me? Testing. Okay. Good. So, so I saw the last session. I don't know who was here for it, but my Lithuanian is a little bad. But my understanding is that Enterprise Lithuania is launching a new government space program using bits of the NASA space shuttle and competing with SpaceX, right? Did I understand this correctly? And you're all astronauts in training, and I'm meant to be talking about space stuff, right? Okay, so maybe not. But what I wanted to talk about was strategy for startups. And I've got two titles here, one facetious one on the bottom, how to focus on trees while selling the forest. But basically, these topics come from spending quite a bit of time working with startups, including ones I've been in myself, on how to start, how to move faster to get, especially the early stages of your business, in the right place. So a little background on me for those of you who don't know me. So I was at Stanford Business School during the first dot-com boom, and some of you who are a little older will remember these days. These were the days when a company like Webvan recruited the head of what was about to become Accenture and put well over $1 billion into a company to do the online grocery business, built dozens of $30 million warehouses and went bust within 18 months. Okay, this was a crazy time. It was also a very fun time to be in the Valley, and that's where I caught the bug for going into the high-tech startup space. I did spend a couple of years at Bain & Company doing strategy consulting for bigger companies, but we also did an interesting project looking at some of these startups at that time, and pretty well predicted that some of them were going to not survive. But since then, I've spent about 12 years building high-tech startups. Two of the main ones I've been involved in, one is Aeroscout. Some of you may know, it's an enterprise solutions provider, both hardware, software, service for doing Wi-Fi based real-time location, tracking medical devices in hospitals and various other things. But it went through a lot of different incarnations before we ended up with that business model. And more recently I worked for a couple of years at Live Bookings, which is Europe's leading online restaurant reservations service. So I've spent some time running business development, marketing, product management for these companies. And more recently, I've spent quite a lot of time involved with startup accelerator programs, Seed Camp Mentor, Hack Forward Referrer, and most recently, I'm right now in the middle of the Startup Wise Guys program, where I'm lead mentor for this. It's a Italian-based startup accelerator program. So, seeing a lot of startups struggling with this issue of how to get started, and this is the weapon of choice that most of them start with. Does anyone know what this is? This is a sawn-off shotgun, okay? This is what gangsters use, right? They put beneath the coat and they pull it out and they shoot. It's very effective at close range, at doing nasty damage to people, but it's highly inaccurate at anything beyond about 5 feet. Well, basically, this is what a lot of startups do. They say, we're going to do everything, right? Over here, we're going to change the world, we're going to do everything. And the problem is that that's a very hard target to hit, okay? But that's mostly where I see startups start, is saying, you know, we're going to conquer the world, and we're going to change this, we're going to change that, we're going to do this, and it's going to be fantastic. And that's a great concept, but it's very hard to execute. And the reason why startups do this is they're worried about investors, right? Because you start having conversations and you go to these startup conferences and everyone's sort of saying, well, how big is that market? You know, are you addressing a real big problem, right? Are you solving something serious that's going to make you an Instagram or something else, right? And so the temptation is to keep focusing on these really large, vague problems because you need to raise money, right? And that's the perception. So this is the dreaded question, right? How big is the market? So when you have your concept, you know, you're thinking, how can I explain to the investor that this is, you know, $1 billion or $5 billion or whatever dollar market? And so I see a lot of companies struggle with this because what they end up doing is then they present these very broad, vague concepts which don't have enough meat to get your day-to-day startup activities rolling correctly. So the fact is, though, that the investors are buying into companies focusing on three things, and in this particular order. The first thing they're buying is team. Okay, and you hear this, but it's really true. Investors, at least smart investors, are buying team. They're buying people who will take an idea, they're going to run with it, they're going to develop it, and they're going to try and find a business model and try and build a company. Okay, and the reality is that every single startup that starts ends up in a different place than where they originally thought they were going to be. And until Steve Blank came along and wrote some great books about how to build startups and how to develop customers, most people were sort of intuiting their way around this, and he had some great tools for explaining what this is, but it's finding a business model. And it takes time to find a business model, it takes work, and you're always ending up at a different place where you thought you would be initially. So that's why team is important, because team is the only thing that's constant along here. If you're investing in a good team, they're going to execute to actually come up with something. Well, they have a higher likelihood, right? This is a high-risk business. The second thing investors are investing in is traction. They want to see that you can actually get something done and you can get some results. And the third thing they're investing in is market potential, but that's definitely behind the other two. So traction is important because it reduces market risk. So if you can show that a team can get some traction, some real tangible results in the market that they're aiming at, then obviously it's more likely they'll be able to capture this large market they're talking about. And it's also, in reverse logic, it's the proof point for the team, right? So if you have a team that can generate some early traction, that's demonstrating that they're a good team, they can actually execute something. So market size is really hypothetical, right? This is a hypothetical potential issue, and everyone gets hung up about it, but it's conjecture. It's an argument, right? It's saying, you know, we will do this, and then we will change this, and we will earn money from here, and it's basically all built on Excel spreadsheets. And as we know, Excel spreadsheets are things which can be, you know, made to say anything. And the question is whether your argument has logic, has good assumptions underneath it, and so forth. But in the end, it's still an argument, okay? So the issue, the problem is, you know, why this becomes a problem is the issue of focus. Right? And for a startup, focus is absolutely fundamentally critical because startups, by definition, are working with limited resources. Right? They've got coins to count, and they've got only so many coins to spend until it's dead. Right? Until the startup is over, you know, you can't pay people anymore. You can't, you know, you have creditors knocking on the door, or you just, you know, can't get anyone to do what you want them to do anymore. So the time you have, the runway until you run out of money, it's critical that you really focus. And of course, if you don't, you end up without any money. And at some point, even your co-founders, some of them you know, might have families to feed and so forth. At some point they say, you know what, we got to give up. So you have this limited time in which to make progress, in which to show traction, in which to show investors that you've got something going. And so if you don't focus on the right things, you're going to run out of time. So what to do? So the key here is to focus laser-like on a particular niche, on a narrow market segment, but keep the whole market in view. And this sounds like a kind of an odd combination. And it's not something that's that easy to pull off in practice, but it's the absolute key to getting a startup through the early phases. Because you have to pick something very narrow, something very defined, something tangible that you can work on and aim at, so you can execute with the minimum loss of momentum. But you at the same time have to present to investors a concept that's big, attractive, and looks good for an investment. Right? So you have to put these two things together. And so the point is you have to find customers that will buy your minimum viable product. And I'm assuming most of the people here in the room are familiar with the term minimum viable product. And I here put double, minimum viable product. You have to find the customers that will buy whatever you're building in its completely rudimentary, most early phase, right? So alpha product, beta product, but with stuff falling off, with bugs, with whatever else. Find the customers that will buy something in its most raw stage. And these are customers for whom the need to solve this particular problem or the interest in having this particular benefit that you can provide them is as great as possible. They need to be as similar as possible so you can produce the same thing for all of them, right? Because as soon as you start to target a broader market, differences in customer needs show up. So you want to make it as narrow as possible. And you need to be able to access them as easily as possible. It's going off the bottom of the slide there. So, so this is really the crux of it. Let me make it a bit more tangible to give you an example. So right now in Startup Wise Guys, I'm working with a team called Vital Fields. Actually, they're just renaming themselves now. They used to be WeatherMe, but they're called Vital Fields now. So these guys have some algorithms that do weather forecasting very accurately in a local area, and they're combining them with some knowledge around what you should do to crops at certain times given certain weather conditions so that they can help farmers make better decisions on when to use pesticides or do other things to their crops so they get a higher yield and they earn more money, right? It makes logical sense. And these guys started in Estonia. They've got a small farming community that's excited about using this, and they're working with them, and they want them to test it, and there's all sorts of things they could do for them, customized weather forecasts, alerts, and everything else. And the problem is that they're focused on one set of farmers in Estonia, which is a small market, as you know, it's smaller than Lithuania, right? And the farmers there, and then when they come to investors, they need to be able to convincingly tell them, we have a big market to attack, and we can tackle a global problem. So what they were doing was focusing in a very narrow geographical space because it's kind of close, it's easy. And so we actually came and looked at this, and we sliced it completely the other way. So instead of looking at a set of farmers, which was significant for the small local market, we sliced it by crop. So I said, so what's the one crop that you can provide a single alert for, a message to help farmers globally? So that turns out to be oilseed. Oilseed is the most similar in terms of types of weather problems and weather-related decisions globally. So if you take just oilseed and you look at the global market, what they're doing now is focusing on trying to have a single alert for a single crop, for a single decision for oilseed farmers worldwide. It's a very narrow target, but it's a completely different narrow target than a set of farmers to solve all of their problems locally, right? And you can see from an investor point of view, that's a much more attractive thing if they've proven some traction with a narrow set of farmers and a global market than a more broad benefit and different kind of features for a smaller number of farmers in a local market. So, in general, there's a few sort of guidelines around this to be more general again. So, for the business to consumer area, the key is to narrow in on a target user group, right? Facebook didn't start by providing a social network for everyone. They started with college dorms and people having communications within a single university. Right, and they moved out from there, obviously after success, but they focused on that target group, and they did things that made their product work well in a university dorm before they made it more general. If you're aiming at consumers, you need to pick an age group, men or women. Find the one group that you can really aim in on and focus on. If your driver here for getting early traction is looking at the decision cycle, right? So one of the biggest problems with business-to-business startups is that businesses take longer to decide than consumers. Consumers are typically very quick to decide. Unless you're buying a car or something else, which is a big purchase. But for most things, in terms of most online businesses, consumers make decisions pretty quickly if they're going to spend the money or not. And there may be a decision. The worst case, there's sort of a decision unit within the family, right? So where the husband asks the wife or whatever else, But that's kind of the worst case scenario. Business to business is different. You might have a whole committee of people who are getting together to talk about, whether to buy this or that. They may have tender processes and all sorts of other things. And this creates a massive problem for business-to-business startups to get going quickly and to get traction. So looking for a short decision cycle is essential. And there are several things you can look for. So one is to break down what you're selling into smaller components so the decision is faster. So sell the initial pilot project, trying to prove the minimum, and then do a second phase project. Look for things that people in the business can buy on their expense account, right? So some of the smaller business decisions, some people will be able to just expense. They don't need to go through a procurement approval. They just put that, whatever it is. It might be 500 euros, 1,000 euros, 5,000 euros, depends on the business and the type of decision. But they could put that on their credit card and just expense it. That's a much faster decision than going through the procurement process. So in business to business, looking for ways to design your early products around these faster decision cycles is very helpful for getting there. I mean, at Aeroscout, we did pilot projects, and we would ask the customer, how much can you expense? Right? We'll do a pilot project. We're not going to charge you all of what it's actually going to cost to implement this system in your one hospital wing here to track these medical devices, but we'll charge you, how much can you put on your expense account? And then at least we know they have a commitment of paying something, but the decision cycle is much faster because they're basically thinking, all right, what can I get away with, right? And so you need to actively think about how to make that decision cycle short. So then you need to look at specific features you can build for this niche market, right? If you're focused on these farmers for oilseed, there are certain things that you'll do slightly differently that will make it work just for them, right? And you have to find these things. You have to look hard and then make these tweaks so that for that particular niche customer group, it's amazing. And I think just that one thing that you wouldn't do for a mass market, large focused product, just that one little thing is what says, this is great for us. This is great for the university market with big research facilities, right? So there's something about researching here. Whatever it is, you need to find those specific features and build them in and talk about them. Because those are the things that are going to get that one niche moving faster. It's going to get one particular user saying, they built this for us, right? And then they'll tell other users, and you'll get more adoption within that segment, because word of mouth, as we all know, is the best way to build sales. So then look at specific marketing channels. In the startup world, I'm sometimes amazed to hear how much the focus is on getting into TechCrunch, right? Or the next web, or GigaOM, or something else, right? This is what people in the startup world think is like cool and hot, and this is success, right? Getting into TechCrunch. But actually, for building your initial user base, that often will not be the case, unless your initial user base is startups themselves, which is not a bad place to start, by the way. Some startups I've advised, I've said, look, if you want to build your content in a particular niche, build it for startups, because that's your sort of natural user market. But for a lot of businesses, like at Live Bookings, we were in the restaurant space, we don't really give a shit about TechCrunch. It's nice from the point of view that other investors who may invest in later rounds will see some information about us and so forth, but we're interested in Restaurant Magazine, right? We're interested in something that's niche, small, and I mean, in the UK, in Restaurant Magazine, you know, they just got tired of writing about us because there was no one else to write about. We were in there all the time, but that was the market. Those were the people who were our customers were reading that, right? So when you pick that early niche, you know, one of the things to think about is what are the publications that you can access. So I'm also advising a startup called Infogram in Latvia, which has recently got into the Hack Forward program. They do an interactive infographics product. And we got featured in Ars Technica a few days ago. You know, this is a niche blog, but for that space, very important, right? And so these smaller publications, the blogs, the industry magazines, the particular, you know, niche consumer journals, they're usually easier to get into because they don't have as many stories. They don't have this legion of people attacking Mike Butcher to try and get into TechCrunch, right? And so they'll often be more interested in what you have to say, especially if they're a non-techie magazine and you're presenting something innovative and new and exciting. It can be a great story, and it can be much easier to get in there, to get featured, and you're actually talking to the audience you want to talk to. So think about these channels and think about how you can get that working for you. And in general, in terms of marketing channels, the advice is to focus on fewer and more, and put much more effort into each than just to broadcast things broadly. And this approach allows you to do that. So once you have this initial sort of first few users, the key thing is to talk to them. Talk to them personally, because this is your best source of data to figure out A, whether you're doing this right at all. Are these the right users you want? And B, what could you be doing better so that you get even more of them, right? And you know, I talk to startups, and almost the first question, whenever they've actually launched something, my first question is, all right, so who are your actual users now, right? Where do they come from? What do they look like? Have you talked to them? It's a very simple thing that all CEOs of an early startup, when they've launched beta, should do, is to send a personal email to every single person who's signed up and using it. A personal email. I don't mean one of these, you know, email template, Dear X, you know, we're excited you're using our product, blah, 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 right? Because everyone's going to press delete. It's different when you get a personal email that is from the CEO of the company of a product that you've tried out, you think is maybe interesting. You get a personal email from the CEO saying, me and my team have worked on launching this product. We're really excited about it. We want to know what you think, right? This is a totally different response rate, and you'll get much more rich information about why they're using it, how they're using it, what for, what are the problems. You want that information. So make it personal. Even if you do use an automated email producing tool of some kind, make it look like the CEO sent a personal email and click send for every single person, okay? Because that changes the response rate dramatically. And then get on the phone. Consumers, business to business, whoever. It's easier in business to business because you tend to have often a face-to-face conversation, unless it's the SMB sort of online segment. But in any case, get on the phone, talk to these people, hear their voices, go meet them, because this information is invaluable for you to figure out what you should be doing better. And often the early users, they're the evangelists, right? And the early evangelists, and they're the people who are willing to try something that others in their industry may not be. And they're usually more willing to talk and give feedback and so forth. So you really need to do that. So then you can focus on fewer, returning, paying, satisfied users and customers. So, you know, I know when people launch a new site, say they're looking at visitors, right? Well, visitors needs to translate into actual returning visitors. She needs to translate into people who are actually using all the product, who are actually paying for it. And the most important thing is to try and find a small set of users who are really adopting the product, ideally also paying for it, or you have some way of monetizing it, and focusing on them. And that initial traction, that's what the traction piece is about, right? The investors will be much more impressed if you have 500 users who are coming back every single day and they're using these features of the product and you know why they're using them and what for, right? Than there will be if you have 10,000 or 100,000 page views, and people are coming and they're going, right? So focus in on these initial users really hard and making them happy, because the investors are looking for that, for proof of traction, proof of executing, not just we have an idea, but we have an idea, we've actually implemented it, we've actually delivered it to customers, we've dealt with some customer support issues, we've dealt with being able to get this product to work. That's about traction, it's about proving the team. So what that means is you can do rapid learning and iteration. You've got very direct contact with the customers. You're understanding what they're doing. You're looking at the logs. You're looking at how they're using the product. And you can then iterate rapidly, right? And you're iterating on a focused niche. You're not, doing iterations for, maybe we could do this feature or that feature that might suit this group or that group. You're focusing in on a single group. And that allows you to make product decisions much more easily. If you have a broad market, then you're sitting in these endless conversations that I'm sure some of you have been in, which says, well, we could do this feature, we could do that feature, but well, maybe people will like this, maybe they'll like that. But if you focus in on this customer set, that decision will be easier. Is to do, which is important for these customers. Have you talked to them, right? Because if you're friendly with those first few customers, you can throw them these ideas, right? And in those conversations, you can find out what would be more important for them. What would make them even happier? So then you pick the next niche, right? You're in the cereal aisle in the supermarket. You've dealt with Kellogg's. Now go to Captain Crunch, right? Pick the next niche. Make it close, right? So the key here is the minimum distance between one and the next, right? Maybe you need to add 2 more features, and then you can help these kind of people solve this kind of problem. Right, make it as close as possible. So in the restaurant space, Live Bookings was looking initially actually at the high-end restaurants that required a lot of table management. They were managing complex table setups and complex reservation stuff, and then they moved to the chains where there were a different set of features. It was more sort of enterprise features. They needed more control from across multiple locations, so you add some features there, but it's close. We had endless conversations with people coming up and saying, well, why don't you do dentist offices or salons or something? It's all reservations, right? You need reservations for all of them. Sure, it's the same thing. It's not the same thing. You need to build a whole bunch of new features that have nothing to do with your original target market, and that diverts you from being focused on making a success in that market, right? So the other key to this is learning to say no, right? And when someone comes up to you and says, wow, I really love what you guys are doing. If you added these things, you could serve us, and we'd love to buy it, right? And you have to listen to those, and your first answer needs to be no, and I'll really think about this hard, because these 3 things may not be related to what you're originally aiming at. And so you want to think hard about which this next niche is, and basically start picking them off so you can gradually grow that user traction. So another thing that I've experienced a lot, especially with Aeroscout, which was an enterprise type of company, is the whole big reseller, big partner problem. Right, so it's great when you've got some initial traction. You maybe have your article about your seed funding in TechCrunch or whatever it is, and you get a call from Cisco, or you get a call from Intel, or you get a call from HP or IBM or a big telco. Right? And you're like, great, okay, they're interested in working with us. That's fantastic. And the problem is that it can take forever and bog down all of your time in trying to do something with these big companies, because they don't move like startups. So to illustrate this story, I'll tell you about Aeroscout. So Aeroscout actually had $62 million of funding over 10, 12 years. And one of the early investors was Intel. So Intel was an investor, and we thought this is really great. But there was a big downside with Intel being an investor, with all due respect to them, which was that they, of course, wanted us to do something with Intel in terms of a strategic relationship and so forth. But I spent lots of time in meetings with one group from Intel, telling them what all the other 10 groups in Intel I'd met with were doing. Because they're a big company, they don't communicate with each other, very easily, right? So we got bogged down in discussions about the strategic roadmap for this particular chip group, developing this, and whether we could fit into that, and would it work with this other chip group, and so forth. And the name was great, but it comes with a cost. So at Aeroscout, I signed a reseller deal with IBM. Okay, so this is back in 2003 maybe. It took me about 2 years to get IBM to sign a reseller deal. This is not easy, right? And I'm spending 2 years convincing them, going to all these meetings and everything. We're gonna work with you. It's gonna be big. It's gonna be huge. We signed the reseller deal, and guess what? We didn't earn a single dollar from IBM for another 3 years. Okay, because IBM is very slow, right? They move at big company speed, and it was nice for us to have that reseller deal, but had I gone back and done that again, I would have waited another 2 years. I would have waited, which is what we did in some other places, until a reseller came knocking on our door and said, we really want to do a deal with you, right? Instead of me going and knocking on their door. Because startups need to move at a different speed, and so big partners can really, really slow you down, and you need to think very hard whether the name is worth it. You're much better off going and getting a customer directly that's actually buying from you, and is the same customer that the big partner, IBM or someone else, also wants to sell to. And then that customer will say, well, you need to go and work with Aeroscout if you want to sell to us, right? And then IBM will come to you, right? So you're much better off focusing on those end users and being reactive and pushing off these discussions as long as possible. In the consumer space, it's maybe less of the same thing, but you still have some of that you may have a large business partner that wants to work with you and wants to work with your emerging consumer brand, and you just need to be careful about how much time you spend on that, right? And what benefits are you really getting from it? So once you've focused in on this niche, we need to go back to the original problem, which is, how do you convince investors that this is a billion-dollar market, right, or whatever the size is you're aiming at? And here it's all about creating arguments, right, and creating the logic, and ultimately it comes down to assumptions in a spreadsheet, right? The arguments why this particular focus is going to lead us to be able to conquer the world. And if you focused in on a niche customer set, the logic is fairly straightforward, right? If I adapt my product in the following ways now, over the next year, two, whatever it is, I'm going to be able to tackle these other market segments, which are similar, and the underlying problem is the same, but I need to make these and these changes, and then I'll be able to tackle a much larger market. And that's the whole damn point of raising money, right? Is that you can build a larger team, which can build a more complex product and more features and more solutions, so you can serve this broader market. But unless you focus in on the initial narrow market, you may never get to the point of raising the money and being able to build something broader, right? So Instagram was iPhone only. I think they're even now iPhone only, right? And they aimed at this narrow market, and they did that really well, and they made it work bloody well on the iPhone, right? And I'm sure they had a million conversations with investors saying, yeah, you need to, or not with investors, but with customers. People saying, send us the Android version. When are you going to have an Android version? And they didn't, because they were focused on doing this really well, and we all know how that ended up, right? So the whole big market potential thing is about how you create a logical argument and have some data to back it up as to why you will be able to conquer the world. And you have to paint a story. It's a vision, right? So this big market is a vision. This is what we're going to do. But it's a story you have to create based on some real information about traction in a narrow focused niche. And you also need to remember that you are presenting different information to different people, right? When you're on your website for consumers or for your particular business target customers, you'll have a certain set of communication for your customers, your users. And that's different from what you put on Angel List that the investors might read, right? So that communication can be different, and you should think about those two things quite differently, because they're not the same thing. So, of course, with all the rules, there's always exceptions, right? So let me give you two categories of exceptions. So one is, an example here is Mighty Fingers, which is a team in Latvia, recently got into Seed Camp, that is doing an HTML5-based game platform, okay? So these guys went to start up Sauna, I think, close to 18 months ago. Went to the Valley, and it's a young bunch of guys. They're all in their early 20s, great programmers, and they have this idea about doing this gaming platform. And it's been extremely tempting for them to do what I would logically argue, well, why don't you just build some damn games that prove what you can do there, right? But they had a vision of building a platform. And they've got the funding now, and I believe they may be the Unity engine for HTML5 in some years from now. And it's very cool. But this is hard to do, and this is a risky game to play, right? So the platform business requires, for them to succeed, they need a whole bunch of developers doing game development to adopt their platform for their success, which means they are dependent on this company. And as a startup, if you're thinking about creating a platform, remember a platform means that other companies, maybe big companies, are dependent on you for their products, which is a big risk to take, right? Especially if they're dependent on a startup. So it's a risky strategy. And when I hear people, startups presenting the concept, we'll be the platform for this, the platform for that, I'm usually rolling my eyes, because it's not an easy thing to pull off, right? I think these guys are going to succeed, but you need to be very careful about it. And Aeroscout is in some sense another exception. We had arguments with the VCs again and again and again. The VC, we'd have a project in the semiconductor space tracking wafer lots, right, with Intel as one of the things we actually did that was practical with them. And the investors would come back and they'd say, God damn it, why don't you just focus on semiconductors? And just make your product perfect for semiconductors. Do all the little things that make it work for there. And then you can tackle other markets. And the same was for healthcare. So we had some early success in healthcare. And there are certain things you would do if you're just focused on the healthcare market. There's certification of products. There's certain ways you present the information layer so that physicians would find it easy to use. Structures of users, all of these details that make it specific for a certain user group. And so as Aeroscout, we had immense pressure, and we had all these debates about, damn it, why don't we just drop all of these different industries we're in and really focus on one. And Aeroscout's a success story despite not following that advice for one reason. We were actually dependent on third-party infrastructure and partners for our success. So Aeroscout was the first company to invent Wi-Fi-based location tracking for an enterprise scale. So we were dependent on Wi-Fi infrastructure. And because of that dependency, the absolute critical thing for us to succeed was agreements with the companies that make Wi-Fi equipment, because they weren't going to buy Wi-Fi from Aeroscout, they were going to buy Wi-Fi from Cisco, from Linksys, whoever else, right? So it would be agreements with those companies that we were dependent on. And therefore we had to create enough traction in all the industries that were interesting for them to do a deal with us. And we did, and eventually Cisco signed a deal with Aeroscout, and that was and they invested in everything, and that was how things ended up. But again, risky strategy. It required a lot more capital. We had to raise $62 million, right, to get to where the company is today. Now it's, got a nice turnover of $50-something million and making money, and everything's fine. But that requires you to raise a lot of capital, which has an implication on if you sell, you have to sell at a large price for the investors to get the money out and the employees and founders to get some cash out, right? So again, risky strategy sometimes can work, but is one of the second exception, I'd say. So in terms of what to do tomorrow, if you're in a startup, focus, focus, focus. Pick the green apple, right? Find the green apple, find what it is, focus on that. Paint a big picture about selling all the apples in the world, but make sure you're really nailing it with the green apples, okay? And I know it sounds sort of trivial in some way, but I see startups again and again not doing that. And so it's very important to keep in mind. So with that, I'll end my talking, and I'd like to hear some questions, comments, arguments.
When is the best step? When is the best time to take the big step from initial target, like the Facebook went from colleges and universities, or Instagram should already have gone?
So the question was, when is the right time to take the next step from this niche market to something big? So I think I'd answer that. So partly when you can afford to. Right, so at some point, if you've proven this traction, you've raised money, you're going to raise money with the idea that you will have, or you'll earn money, right? If you can earn money off your early customers and you can bootstrap, you'll have enough resources to start expanding. So it may be when you have enough resources. It may also be when you've tapped out that first niche, because if you've picked it narrowly enough, you might start, dominating this space first. And a lot of VCs will say dominate a certain space before you move on and become known, become very successful at nailing this particular space. And so that's sort of the two ways I'd say of when you think about when to move on to another market. Yeah.
What do you say for investors? What do you say for investors when they ask maybe it's a second .com is coming, like crisis was?
Sorry, what was the question?
When the first .com crisis was.
Yep.
Are investors questioning you
about whether we're in another .com boom? Yeah, so I mean, this debate has gone on now for the last 3 years in the tech press about whether we're in another .com boom, and I think the answer is a little more complicated, right? So in certain spaces you might argue that there's overinvestment. Social media might be one of them, but it's more of the typical case of not everyone invests in the first successes, and VCs tend to operate more like sheep than everyone would care to admit and invest in the same things that others have invested in, and that usually means the later investments either don't work out or are more risky. But the big thing that's really changed, and the reason why I don't think there's a bubble like the last .com is, in the last .com you had a company called Boo.com. Does anyone know what Boo.com was? Yeah, I see someone nodding their head. Yeah, so Boo.com, I don't remember how much they raised. They raised a shitload of money for selling fashion online, right? So they were going to sell clothes online. And they thought this was great. The world is going to change. You're never going to go to, you're never going to get an LL Bean or Land's End catalog. You're never going to go to the mall. You're just going to buy clothes online, right? Everything's different. And in order to do that back in those days, they had to raise money to build a server farm themselves to host it. If they wanted to do it in multiple countries, they had to have server farms in multiple countries because the internet connections across the oceans weren't so good. They needed all of this investment to prove this hypothesis, and of course they failed. They failed because they didn't realize that the catalog companies could move online very easily because they had much more knowledge about how to organize products and how to turn them over and how to work with customers that they didn't meet face to face than a new startup like Boo.com did, right? Now things are a little different because of the lower costs of starting a new business in the internet software world. The costs are unbelievably lower, which is the whole reason for these accelerator programs starting, because now you can start a company with $20,000 and you can actually get somewhere. You can actually build something and have some customers, and that's because you can host everything in the cloud. You don't have to worry about the server farm size, because if you hit it big, you make a call to Amazon and you get some more. You don't call, you email, right? And you get some more bandwidth, and you get some more data space and so forth. So that means the investment required to prove your initial hypothesis and to prove your traction is a lot lower. So that's why I think this .com boom is there are parts of it which might have been overinvested, but a lot of it, there's a huge amount of potential because the costs of doing business have just changed dramatically. Any other questions?
How to know that it is not a startup anymore, that it is a mature company?
Sorry? How do you decide that you're not a startup anymore but a mature company? That's an interesting question. Yeah, because it's interesting because I find myself, whenever I work for a company that has more than about 120, 150 people, I'm like, I can't deal with this, it's too many people, right? And for me, that's when they become more of a mature company. I mean, a successful startup needs to mature, right? So out there we saw the Skype booth, you know, they're hiring for jobs. You know, this is now a Microsoft company, and they've grown up. They're now a corporate, right? And of course they want to keep that startup-y feel, and they want to have beanbags in the office, and they want to do all of this fun stuff, but they're still a corporate, and they need to behave like a corporate, because at that point, the scale of their business is so big that they need more process, more structure in order for it to work, in order to mobilize thousands of people. You have to have structure, you have to have process. Whereas in a 5-person startup, you don't want all of that, because you want to be able to move quickly, and you want to be able to decide in 1 week